Here's something most Canadians don't know. Your RRSP actually has an expiry date. You've got until December 31st of the year you turn 71 to convert it to a RRIF, or the whole thing gets deregistered and you will owe tax on every single dollar. And trust me, that is not a small penalty. We are talking about a massive tax bomb that could push you into the highest tax bracket overnight. But here's what's worse. I see people all the time who convert their RRSPs right on schedule, but they set up their RRIF wrong. And that is costing them thousands without them even realizing it. I'm talking about higher OAS clawbacks, surprise tax bills, and Ontario estate fees that could have been avoided with literally one checkbox on a form. Whether you are 5 years away from retirement or already collecting CPP, you need to understand how this stuff works, because once you make these decisions, there is no going back. So in today's video, I'm going to break down everything you need to know about converting your RRSP to a RRIF, when to do it, how withdrawals actually work in 2025, and the simple choices that can save you thousands over your lifetime. By the end of this video, you will have a clear roadmap for setting up a RRIF that works for both you and your spouse. If you are new here, welcome. I'm Jacqueline Ozdemir, a financial advisor with Ferguson Financial Planning. I spend a lot of time helping Canadians make sense of complicated financial rules, especially the ones that can quietly drain wealth if they are not handled properly. I cannot tell you how many times I sat with new clients who thought they were doing everything right, only to realize a single decision around their RRSP or RRIF was costing them thousands every year. And that's the kind of thing that keeps people up at night. But it does not have to be that way. So today we are going to dive deep into how this RRSP to RRIF conversion actually works. We will talk about the deadlines, how those minimum withdrawals are calculated, the tax traps you need to watch out for, and the big one, that OAS clawback. I will walk you through some real examples and give you a simple checklist to help you avoid the most expensive mistakes I see people make. If you find this helpful, be sure to hit like, leave a comment with your thoughts, and subscribe so you don't miss the next video. All right, let's dive in. Let's start with the rule that trips up more people than you would think. The timing. You must convert your RRSP into a RRIF by December 31st of the year you turn 71. Not on January 1st of the year you turn 72, not any time in the year you turn 72, and not by the end of the year you turn 72. The deadline is December 31st of the year you turn 71. No exceptions. Miss that deadline and the entire RRSP balance suddenly counts as taxable income. Painful does not even begin to cover it. Imagine having $1 million sitting in your RRSP on December 31, turning 72 the next day, and then finding out that the CRA wants to treat the whole thing as income for that year, the year you turn 72. Such an error would push you straight into the highest marginal tax rate, and the CRA won't allow a reversal. In other words, that mistake could take you right off the golf course and drop you into the top tax bracket with no mulligan in sight. Or one slip like that and suddenly you are in the top tax bracket with no way to reverse it. But here's the thing, conversion doesn't have to be all or nothing at 71. You can actually convert earlier, and you can convert just a portion. That flexibility can be a real win if you're looking to smooth out income or take advantage of tax credits. For example, a lot of people don't realize that converting a small chunk at 65 lets you tap into the federal pension income tax credit worth $2,000 of qualifying income each year. A mini RRIF strategy, we'll call it. Here's how it works. Let's say Lisa is 65 years old and working part-time. She moves $14,000 from her RRSP into a RRIF. She then sets up $2,000 a year in payments from that RRIF. Because of the pension credit, those payments are effectively tax-free at the federal level. Plus, she gets a bit of a provincial tax break too in Ontario. Meanwhile, the bulk of her savings stays growing tax-deferred inside her RRSP. Without that little move, she'd miss those tax credits for years. By the time she hit 71 years of age, she has created roughly $14,000 of cumulative tax-sheltered withdrawals. That's significant. So timing isn't just a boring compliance rule, it's actually a lever you can use. Think of it as choosing your start line, not just your finish line. Knowing you have to convert by 71 is important, but knowing you can convert earlier strategically is where the real planning opportunities live. Once you set up a RRIF, you can't just let it sit there. Every year, you're required to take out at least a minimum withdrawal based on a percentage tied to your age, or if you choose at setup, your younger spouse's age. The younger spouse angle is one of those things you only get one shot at. Elect it when opening the RRIF, and it sticks forever. If you skip it, you can't go back. Here's how this plays out in real dollars. At age 71, the RRIF minimum withdrawal rate is 5.28%. So if you've got $1 million RRIF on January 1st, you'd have to take out $52,800 that year, and every dollar is taxable. Now let's tweak one detail. Instead of using your own age, you can choose to base the calculation on your younger spouse's age. Say your spouse is age 68. At that age, the factor drops to 4.55%. On the same million, your withdrawal would only be $45,455. That's a difference of $7,300 less taxable income just from one election at setup. Now, if your overall income puts you near the old age security clawback threshold, $93,454 in 2025 for ages 65 to 74, shaving down that income can preserve your OAS rather than having part of it clawed back. Think about that. One simple election at setup could mean fewer forced withdrawals for decades, more control over your tax bill, and a higher after-tax income overall. The beauty of this is that the math scales. On smaller accounts, the reduction is modest. On large RRIF balances, millions in some cases, it's massive. And over 10 or 20 years, the compounded tax deferral from leaving just a little more invested can add up to tens of thousands of dollars. So here's the takeaway. Always check whether using a younger spouse's age makes sense when setting up your RRIF. If you don't have the option, no problem. You'll simply use your own age. But if you do, that one decision can buy you flexibility, reduced forced withdrawals, and keep more money working for you year after year. Here's where people get really confused: how these withdrawals are taxed. A lot of folks assume every RRIF payment had the tax withheld like a paycheck. Not true. The minimum withdrawal amount has no tax withheld, or at least it's not mandatory. That does not mean it's tax-free. It just means you will have to account for it at tax time when you file your return. So let's say your minimum withdrawal for the year is $50,000. If you only take that amount out, you'll get the full $50,000 deposited into your bank account. No tax shaved off up front. At year end, the CRA treats it as taxable income and you will settle up then. But the moment you take even $1 above the minimum, withholding kicks in. And not just on that dollar, on the entire excess. There are federal withholding rates: 10% if the excess is under $5,000, 20% if it's $5,000 to $15,000, and 30% if it's more than $15,000. Plus Ontario tax on top of the filing. Let me walk you through a common surprise that happened to a client the year before we started working with him, Mar. He set up his RRIF to pay out the minimum plus $6,000 extra over the course of the year. He figured, no big deal, what is $6,000 divided into monthly payments? It won't matter. Here's the catch. The CRA does not look at those payments one by one. They treat the extra $6,000 as a single withdrawal for tax purposes. That means a 20% withholding rate applies to the entire $6,000 or $1,200 in tax. Now, depending on the financial institution, $1,200 might be taken evenly out of each monthly payment, about $100 per month, or it might come out more heavily at the start. Either way, Mark's cash flow will not line up with what he expected. His extra income was not as smooth as he thought because the withholding reduced the actual deposits hitting his bank account. Here's another surprise. Because there's no automatic withholding on the RRIF minimum, retirees with substantial withdrawals often end up owing more than $3,000 in taxes at filing. And if that happens in the current year and the past 2 years, CRA will require you to start making installment payments the following year, usually 4 scheduled payments a year. It can feel like you're paying tax twice, even though it's really just prepaying what they think you will owe. The fix? Ask your financial institution to withhold extra tax from your RRIF payments if you're concerned about this. That way, your tax bill is spread out throughout the year and you can avoid late payment interest and those pesky installment reminders. Now let's talk about the big one, the old age security clawback. This is the silent tax trap that can drain thousands if ignored. For 2025, the clawback starts when your net income hits $93,454. If you're between age 65 and 74, for those age 75 and older, the lower threshold is still $93,454. Upper threshold is $157,490, with benefits fully phased out once income reaches about $157,490. Here's how it works. Every dollar above $93,454 reduces old age security by 15 cents. So if your income is $100,000 in 2025, that's $6,546 over the threshold. Multiply by 15%, and you'll owe about $982 back. It shows up as an OAS repayment on your tax return, effectively clawing back part of your monthly benefit. Many retirees don't notice until it's too late, and suddenly they're surprised at filing. Here's a case study. John and Mary are both age 71 with a household income just under $90,000. John converts his entire RRSP into a RRIF as required at age 71 and starts withdrawing the minimum. That minimum ends up being more than $50,000. Suddenly, with CPP, OAS, and other investment income, his total income jumps well into clawback territory, and he loses a portion of his OAS he didn't really need to that year. Could this have been avoided? Yes. If John had started planning earlier, for example, between ages 65-71, he could have gradually converted parts of his RSP to a RRIF and taken withdrawals over several years. By doing this, the RRIF balance at age 71 would have been smaller, the minimum withdrawal lower, and the OAS clawback avoided. Here are some strategies to help you manage RRIF withdrawals and reduce taxes. First, if you have a younger spouse, use their age to calculate your RRIF minimums. This lowers the required withdrawals and gives you more control over your taxable income. Second, and this is a big one, once both spouses are age 65 or older, you can actually split RRIF income. This is an incredibly powerful tool for tax planning. By allocating withdrawals between spouses, you can cut your combined taxable income, on paper, sometimes nearly in half, helping you avoid higher tax brackets and reduce the impact of OAS clawback. For example, if one spouse has little other income, shifting RRIF withdrawals to them can preserve OAS for the higher income spouse. This isn't just a small tweak, it's a tool that can save you thousands over time. Third, consider drawing down more of your RRSP before age 65, when OAS isn't yet a factor. This can help prevent large RRIF balances at age 71 and smooth your income over the years. And there's a fourth strategy we'll cover a bit later in this video, the new Advanced Life Deferred Annuity, which is another way to manage RRIF withdrawals strategically. The OAS clawback isn't the end of the world, but if you can smooth out your income with tools like age-based RRIF calculations and income splitting, you'll keep more money in your pocket year after year. The takeaway, planning your RSP to RRIF strategy well before age 71 can protect your OAS, smooth your taxable income, and give you more control over your money. When you open your RRIF, you'll be asked to name either a successor annuitant or a beneficiary. And this little checkbox matters more than most people realize. If you name your spouse as a successor annuitant, the RRIF simply continues under their name with no interruption. Payments continue as before, tax to them, no collapse, no probate, not a lot of extra paperwork, everything just keeps flowing. If instead you name your spouse as a beneficiary, the RRIF value is still transferred directly to them and normally bypasses probate. But the account itself collapses and must be re-registered in their name. It's not entirely seamless. It can create extra paperwork, potential delays, and possible tax complications if not handled properly. Probate fees become an even bigger issue if the RRIF is left to your estate. In Ontario, for example, probate costs $15 per thousand above the first $50,000 of estate values on a large RRIF. That adds up fast. Here's an example. Susan has a $1 million RRIF. If she names her spouse Daniel as successor annuitant, the RRIF continues seamlessly under Daniel's name if she passes away. No interruptions, same investment, same payment schedule. But if she designates her estate, the account flows into probate, adding over $15,000 in fees, plus delays that could disrupt cash flow. The key takeaway? For a spouse, successor annuitant is usually the cleanest and most efficient choice. Beneficiary designations are better reserved for children or other heirs. Some additional points to keep in mind. Many people think these designations are just paperwork, but they determine how smoothly your RRIF transfers after death. The choice you make affects taxes, probate, timing, and whether your spouse has uninterrupted access to income. With successor annuitant, payments don't skip a beat. All income is reported on your spouse's tax return going forward, and they can keep or change the investments. With a beneficiary, the account may sit in limbo during transfer, delays that can be stressful if monthly income is needed, and the fair market value at death may also appear on your final tax return unless the rollover is structured correctly, which could create a significant tax bill if it's not. Only a spouse can be a successor annuitant. For children or other heirs, naming them as beneficiaries ensure the RRIF bypasses probate, but the full RRIF value does become taxable income on the deceased's final return, which can definitely be a shock unless planned for with tools like life insurance or staggered withdrawals. At an already difficult time, successor annuitant means no extra forms, no extra decisions, no interruptions in cash flow. Beneficiary just adds extra steps, which can complicate things for grieving families. Bottom line, if you're married or in a common law partnership, always review your designations. Beneficiary is fine for children or other heirs, but for your spouse, naming them as successor annuitant is usually the smarter choice. It's not just about money, it's about making life easier for the person you're leaving behind. Once you've got the basics down, there are some advanced strategies that can give you even more flexibility. And the top tool in 2025 is the ALDA, or Advanced Life Deferred Annuity. It's a newer option, but it's powerful. It lets you shift up to $180,000 across all your registered plans, RRSPs, RIFs, pensions, the whole lot, and delay that income all the way until the end of the year you turn 85. Pair that with your RIF, and suddenly you have serious flexibility in how and when income flows. Another strategy is partial conversions. You don't have to treat your RRSP and RIF as completely separate buckets. You can leave some money in your RRSP and move some into a RIF. This gives you more control over tax credits, withholding, and cash flow, letting you tailor withdrawals to your needs each year. The key is to think about the order you draw from different accounts. For many people, it makes sense to use non-registered assets first, then draw down from your RRSPs or RIFs in a way that avoids clawbacks, while letting TFSAs grow tax-free for as long as possible. But the best order really depends on your specific situation. It can vary based on age gaps, health, or other income sources like corporate or real estate income. The real power of these strategies is that they let you move from reactive to proactive. Instead of simply responding to required withdrawals, you're actively shaping how, when, and from where income flows. And you're doing it with a focus not just on a one-year tax basis, but on minimizing lifetime tax. And that's where the real impact lies. All right, let's wrap up what we covered today. Converting your RRSP to a RIF isn't just a box you check at 71. It's a series of strategic choices that shape your entire retirement income. We talked about timing. You must convert by 71, but converting earlier can unlock valuable tax credits. We covered how minimum withdrawals work and why using a younger spouse's age can reduce your taxable income for decades. On the tax side, we looked at why minimums have no withholding, how excess withdrawals get taxed, and how to avoid those surprise tax installments. We dove deep into the OAS clawback, what triggers it, and the strategies that can help you avoid it. And we covered estate planning basics like why naming your spouse as a successor annuitant is usually the cleanest option for RIF accounts. We also touched on advanced tools like ALDAs that give you even more control. Here's the big picture. These aren't just boring tax rules. They directly affect how much you pay in tax, how much you keep invested, and how smoothly your assets pass to your family. Get it right, and you control the outcome. Leave it to chance, and it could cost you way more than it needs to. All right, let's wrap up what we covered today. Converting your RRSP to RIF isn't just paperwork, it's a strategy. A few smart choices now can mean more money in your pocket later and fewer tax surprises when tax season or estate planning rolls around. Now, I want to hear from you. What part of today's discussion hit home the most? Was it the younger spouse election, the OAS clawback threshold? Drop your thoughts or questions in the comments. I read every single one, and they help me figure out what to cover in future videos. And look, if you're wondering how these strategies apply to your specific situation, don't just guess. There's a link in the description where you can book a call with me. We'll look at your numbers, your goals, and figure out a plan that actually makes sense for you. If this video helped clear things up a bit, hit that subscribe button and turn on notifications so you don't miss the next video. I share practical strategies like this all the time, and each one is designed to help you keep more of what you've worked so hard to build. Thanks for watching, and I'll see you in the next video.